Okay, three, two, one, and we're on. So hello and welcome to this talk at which we are honored to host Fresh from San Francisco to talk about funding projects and how to get the startup into your startup into the world. Fresh is an associate at Launch, which is a venture capital firm. Did I get that right?
You got it. Yeah.
This is okay. So this is a good opportunity for us to know more about the startup industry and exactly from the financial side of it. So without further ado, I will let Fresh give us a word about what he does at Launch and how he is related to the startup industry and the venture capital in general.
Awesome. Right. Thanks so much, Aziz. It's awesome to be here. As you mentioned, I'm an associate at Launch, and really what Launch is, it's an early stage venture capital firm. But we have two different vehicles that we use to invest. So first, I'll give a quick intro to what venture capital is and what we look for. So really, venture capital is just high risk capital that's put towards startups, and startups being like high growth, typically technology companies that are able to grow, very quickly and in big markets. So venture capital money is put towards these startups to help them, achieve growth and sometimes also get ideas off the ground as well. So in our case, Launch is a accelerator, and we're also a syndicate and fund. And so all that means is we have an accelerator program, and that focuses on early stage companies. And so these early stage companies are, typically have a product in market. So they've built, initial version of, something, a problem that they're solving. And that product has some customers and some users using the product. And now they're looking for funding. So what we do is we help them, we invest in the company, but we also help them fundraise and grow through this Launch Accelerator program. So think of it, it's now a fully remote program. It actually used to be in person in San Francisco, where I'm currently located, but now it's fully remote. And so it's a 14-week program. We invest $100K for 6% into these companies, and also introduce them to around 500-600 different investors throughout the course of that 14-week period. And so we do similar to like a Y Combinator or a Techstars. The program really is focused on the founders and how to help them grow. So that's really what the program is. After the program, what's cool is we have a vehicle called the syndicate, and the syndicate is essentially a group of investors that co-invest alongside us. So we share our investment deals with them, and they're also able to participate in companies that we invest in. So we're able to invest larger check sizes, anywhere from $250K to $2 or $3 million through the syndicate.
So basically, you are the medium between the investors and the companies and the startups.
Yeah, exactly. So we've got access to the capital, we've got access to the founders, and then we've got access to all these investors. We connect them together, and the goal is obviously to help the companies grow.
So you've talked about many things when you define the venture capital and what's your mission with it. So I want you to give us like more details about the companies that you take in or you invest in. So you have said that they are basically technological companies. Is it only like restricted to the technological companies, or you are open for any other startups? Or
yeah, that's a great question. So we are open to more than just technology companies. So I would say really what we're looking for is a company that's got a unique perspective on a problem that they're solving. I'll give an example. So we found a company called Soul Savvy. Soul Savvy is not a technology company. They're a company that's built off of community. They use technology to facilitate this community, and it's a community of sneakerheads. So anyone who's really passionate about sneakers comes and signs up for Soul Savvy and gets exclusive information, and it's like a marketplace. And so technically they're not using any like new technology. They initially started on Slack, and so they built their whole company off of using Slack. So there's nothing special about the technology there, but what was special there was the community that they were building and the traction that they were able to get. And so when we met the company, they had 1,000 paying customers, and so that was interesting to us because we were like, oh, that's interesting. Like 1,000 people are willing to pay $30 a month for this product, and it's just like a community. So that tells us that this is a growing community, and obviously we see that it's a growing community because there's a bunch of sneaker apps like Goat and StockX, etc. So we knew it's like a big market and growing. But they had a unique approach. So that's an example of like a non-tech company. We've also invested in a couple of direct-to-consumer products. So like we have a company.
Are they like physical
called,
or just services?
Yeah, a physical product. I'll get into the services in a sec. Actually, you brought up a good point. But we have a company called Outlaw Soaps, and it's a soap company, but they make these amazing soaps that smell delightful. It's a unique product. And they had, pretty great sales. And so we were like, yeah, we want to invest in this company. And then another company, which I reviewed, this is actually funny. I got the sticks right here.
I watched the video. So
yeah. I reviewed them. This is Free Drum. This is a cool product. It's like sensors on your drumsticks, and it's based
so
on
basically
accelerometer.
you're playing with them in the air, and then you can hear music within your earphones.
Exactly, yeah. And so that's a hardware and software company. They've got software on the back end, of course, but it is also a physical product.
Awesome.
So yeah, we'll touch over many different areas. But one thing, the services question that you had.
Yeah, what is like the percentage of the companies that the applications you receive? If you can give like a stat, what is the percentage of services to the physical?
Yeah.
Or physical companies?
Yeah. Like comparing the two?
Yeah.
So I would say 70 to 80% are either software or technology enabled companies.
Great.
So the rest 30, maybe 25% are like direct to consumer physical products. And then like 5% are maybe like, deep technology stuff that where the product doesn't exist yet, but it's just like a very technical team that have a solid background and are working on something like 5-10 years out in the future.
I see. So I have a question that is kind of not related to this, but I have it in my head. So do you invest in technologies that are like volatile? For example, the artificial intelligence related product that are not yet established or sure. Do you take that risk or you eliminate it?
Yeah, that's a good question. So we would take the risk as long as there's something that gives us enough, data to think about, if this could be a big opportunity. So like with artificial intelligence, as an example, obviously we know that's coming. So it just, I guess, depends on the application that's being used. So, we'll take the risk as long as they're able to show that, people want this product, or, they're doing something, extremely unique and yeah, people are willing to pay for it. So we're the way we invest is we'll typically look at any company as long as, they've got a product in market, because that's that's almost like step one, right? The idea obviously isn't.
So like a threshold that you need to cross.
Yeah, the threshold really, in most cases, like majority of our investments are made with products into teams that have been able to put products into the market, because that gives us a signal, right? If we can see now, oh, this team is able to ship a product. And now let's see if people are willing to pay for it.
Great. So this takes us to the next point, which is For example, if someone wants to get their application, their startup funded, what is the process? What are like the steps that they need to follow in order to get funded or to put their application in the process of yours?
Yeah, that's a good question. So yeah, I mean, really, if you're outside of the industry, um, and not really in the tech world, there's a couple ways that you can do it. One is simply just like emailing investors. A place where investors hang out a lot is Twitter. They're there 24/7, and so engaging with them on Twitter, a lot of them are pretty open to taking pitches and have their email publicly available. And so really emailing them, but being smart with the email. Not writing like a huge paragraph and three paragraphs of what you're working on or what your idea is. Really just getting straight to what your product is, and only really email them like if you've built out something. They'll typically read over idea emails anyways. So keep it like very short, a couple lines, maybe even a screenshot of what the product is, or a screenshot of your growth. So if you have a user chart that's shaping upwards or is wavy, but you have some trends there, send that. So emailing is that. The other is applying to different accelerators. That's another option. Our accelerators like ourselves, Launch Accelerator, is great to get the companies well connected. So we have a huge founder network and investor network. So just going over to our site, or the other accelerators out there, and filling out our application form.
So there's like a website. There's a website that you need to go to with the application.
Yeah. So our website's just launchaccelerator.co, or you can go to launch.co/apply and fill out our form, and our team reviews it and gets back to the companies in a couple days.
Great. So for example, there are two ways of handling this, as you have mentioned. There is the classical way, which is to go directly to the investors, or to go through a medium, which is like the accelerator that you have mentioned, like yourselves.
Exactly. Yeah.
So for you, let's talk about the second one, because like we don't have access to the investors right now. So let's talk about the accelerator. For someone who wants the application to be reviewed, what are the criteria that you need to have in your application, or what are the elements that you need to have in your application so that it gets the attention of the team?
Yeah, that's a good question. Yeah, because there's obviously so many different applications incoming. So to stand out, the number one thing would be, well, for us, one of the main things is like we want to see a cool product. But that it could be a cool product with zero traction, no users, and in that case we would say it's too early. But the ideal thing is it's a cool product, designed well. I'm able to go to the website and see what the product does and understand what it does. And then the next thing is really like, are people using this product? Like, is it in market? Are people paying for this product? So that kind of fits into the traction component. In the traction component, we want to see like a little bit about their growth. And this doesn't have to be a lot of traction. Like it could be a couple $100 a month to a couple $1,000 a month, as low as that really. But we want to see that people like this product, people are paying for it, and there's some growth, over time. So in our form, we actually ask for like, if the product is in market and it's generating revenue, what was last month's revenue? What was 2 months prior revenue? What was 3 months prior revenue? That just gives us a sense, like, is this company growing in revenue, or is it flat in revenue, or are they declining in revenue? And that just really like tells us if the company has product market fit. And that's like really number one, right? You could have a great product, but if it doesn't have product market fit, then it's going to be hard to grow.
So basically you are evaluating the financial side of the startup at first. The first stage is this.
We take that into consideration. I wouldn't say that's the only thing we're looking at. That just tells us that the team is able to put out put out a product and test, quickly and get feedback from that. But like I said, it's very small numbers. So like from hundreds in monthly revenue to a couple thousands on the lower side. We've seen companies with 40, 50K monthly revenue come through the accelerator as well. Because they're trying to optimize and meet all these new investors. But yeah, I narrowed it down to like, a good product and, product being in market. Those two things actually filter out a lot of companies because a lot of applications are like ideas or products that are MVPs at this point. And so that filters out a lot of products. So having a real product, already puts you towards the top of the list.
Is there like a threshold of the number of companies you can accept, or you can accept whatever, no matter what the number is? It just needs to fit the criteria and seem to be profitable in the future.
Yeah, that's a really good question. So our accelerator, we do 8 cohorts a year, and we accept 7 companies, right? So we're doing like 50 plus.
7 companies a year?
We do 7 companies per cohort and 8 cohorts a year. So we're doing 50 plus, accelerator, 50 plus companies through the accelerator. And then, we'll, out of, all the applications in the year, we make investments in 50, right? 50 or so, over 50, through the accelerator. We also have the syndicate, but that's for the larger check sizes. And so, we're just looking at investments through, making, per cohort, I guess I should say, we run a class, or an accelerator every 6 to 7 weeks. And so there's always a new class upcoming.
So every 2 months, like there's a class.
Yeah, exactly.
And can you give us a ratio of the success rate of the companies, like the number of application and the number of the startups that make it?
Yeah, for sure. So we measure our success on companies that get funded, right? Because they come to us with having not raised a round in most cases, and our job is to help them raise their, typically it's a seed round, so anywhere from $1 million to $3 million. So our success is in terms of the 7 companies in each cohort, about 70. I'd say probably 75% of the companies end up closing their seed round.
Great. So
yeah, and that's like, so I'll give an example. So a company comes through our program. They've raised maybe a couple $100,000 from friends and family. And now they're wanting to raise a proper seed round. So they apply to the launch accelerator. Let's say we accept them. We help them meet with the 15 to 20 investors every week through our program, help them with growth as well. And then by the end of it, or sometimes even during it, their round is coming together, right? Because they're meeting all these investors. And in some cases, the round ends up closing before they finish the program, just because, a lot of investors are interested in the company. And so once that company's round gets filled or closed, that's, a success metric, that we would look at.
Awesome.
So around 75%. Yeah.
Okay. So we've talked about the positive side, which is how the startup gets accepted, or what are the criteria that if this application met, it can be accepted. So let's talk about the downside here. What are the signals that if you find them in an application, you reject it immediately?
So immediately, that's a good question. So we review all the companies. We want to look at everything, even the idea companies, just to have a touch point with the founders, because founders will often maybe have an idea 1 year and then in 6 months execute on the idea, and now it's a big company. We've seen that countless times, and so we want to. Our whole thing is supporting founders, inspiring innovation. So we never want to, just say like, don't talk to me, founder, like you're not ready yet kind of thing. We'll say you're not ready, or, it's too early. That's the phrasing that we like to say. but we like to keep in touch with everyone. So we have like a public email. It's called launch@updates.co. We say if any company is too early, or they just have an idea, just shoot an email to updates@launch.co. Anyone can email it, and our team will review it and we'll track your progress. So I wouldn't say we ultimately say look at a company and then just toss them out. We'll still want to build the relationship over time. But the things that do not make it obviously to the top of the pile is just not having any traction or not having any users for your product. So that's probably number one. No one using the product, it's hard to tell if there's even product market fit, obviously. So that's probably number one, the traction part of it. And then, we'll look at design, although design can be improved. It's to tell if, the product is really janky, or, even product design, or even just how the onboarding is into the product and all that. Just seeing how thoughtful that is. That's not a huge concern, I would say, just because all that can be learned and improved upon. But the hardest part is product market fit. So I think I'd just narrow it down to that, the traction part.
Great.
I'll say different types of businesses, right? So as a venture capital firm, and in startups and tech, we're looking for outcomes that can be 100x, 1000x, 10,000x, right? So these really big outcomes, outsized returns. And in order to get that, you can really only invest in a certain type of business. So, for example, we don't invest in services business or consulting businesses, right? And the reason is because those are
the growth is pretty slow.
Exactly. Hard to scale, right? And, involves a lot of hiring, and it's pretty intensive. So we won't do a consulting business, although, those can be, very, profitable companies. They just won't achieve that outcome in the timeline that makes sense for us. So services, another is media companies in most cases, like a content company. It's very hard to break out. Obviously, you've seen that, with Quibi even. They raised billions of dollars and didn't really have product market fit, and unfortunately couldn't.
It went down.
Yeah, it went down. Yeah.
So basically, what you are giving priority to is the products that can be automated and scaled very quickly. So
yeah, some aspect of that. Yeah.
What is the timeline, for example, for the scale to get to 100x?
Yeah. So typically, the standard is 7 to 10 years. That's really when you'll see an outcome. In most cases, sometimes even longer. You'll see that with Shopify or with Shopify or with Spotify. Their outcome was 10 plus years later. And so it's really a decade long journey that you're committing to when you invest in startups, right? Because it's not going to happen overnight, and there's going to be a lot of problems that come up, and there might even be a pivot. The initial product that we invested in might be a different product by the time it's successful, and so that's when really making the bet on the founding team and the market is an interesting idea that we look into as well.
So I have one question that intrigues me, which is, how do you protect yourselves from frauds, for people that just want to get the money and run away?
Yeah. So we do something called diligence. Not everyone does it. Some people will do a Zoom call like this and write the check, and that's totally fine. That always happens in the industry. But we do our diligence on every single deal that we touch, and so we have obviously the resources to have a team. So our team launches 12 person company at the moment. maybe more. But we have people dedicated to diligence. So, for example, I'll do diligence on many of the accelerator companies. So what that entails is like we're asking for their bank statements. We're asking to see their P&L, to see how they're spending their money. Like is the CEO salary like $20,000 a month? Like that doesn't make sense when they're not even profitable.
Yeah.
You know what I mean? Just like things that we're able to understand, like how they're spending their money. Then we talk to customers. So that's a big thing, right? That's the one thing that you can't fake is your customers. So we call them, we set up time to meet with them, understand how they use the product. And that allows us to say, oh, okay, people are really using this product. And then we ask them, like, if this product were to go away, what would you use? And that's another telling question. So that's really how you do it. It's just
So
taking in.
at the end of the day, it's a risk. It's a high risk.
Yeah, for sure. It is a high risk. Like they could fake that. They could fake all the documents, but it would be hard to fake a customer, right? That's the one thing.
That's right.
So it's hard to fake your customers, and so we call the customers.
Okay, great. So you've talked at the beginning about the application, and you have said that it's all remote right now. So my question is, do you need to be present in San Francisco, for example, in order to get your application to the launch, or you can like apply it from anywhere in the world?
Yeah. So the great thing is, since the pandemic happened, everyone's kind of forced to go remote, and it's been great for us because we're now doing exactly that and able to accept more companies, kind of around the world. And so I would say the answer is no. You don't have to be in San Francisco for us to look at the application. The reason San Francisco was, the prime spot, and still is in many ways, but more so before the pandemic, was because a lot of the investors, just lived here. So it's easy to get in touch with them. But now everyone's doing these meetings over Zoom, and so there's no really barrier in terms of location. So we've made investments in Australian companies. We've made a couple investments in Europe most recently. And so, really, we're looking all over. One thing that we do look for, though, is that the company is building a product that also services, U.S. customers or North American customers, because that obviously is such a big market. So we want to see that, that's, somewhere in their roadmap as well. But obviously, now you see like huge opportunities in China and India, and you have like funds setting up offices there, like Sequoia China, Sequoia like being the best venture capital firm. They have a huge office in China, just making investments in Asia, and so we're open to companies coming from wherever.
Man, great. So I got a point for me, which is like another point that will make your application stronger is to target the North American population or customers.
Yeah, I would say that's a good point that you brought up for sure. If your traction is incredible in another market, and it's let's say obviously a growing market, but yeah, I think you're on the right point. Like we want to see that they've got some traction in North America as well.
Great. So now the stage which how do you evaluate the value of the company, and how much money do you put into that company? Is it up to you to define that number, or is it the founder that asks for a certain amount of money, and then you determine based on that the percentage that you should get from the company?
Yeah.
What is
Very
the
good.
formula?
So ours is, we've simplified it, and we've really simplified it. So there's not too many questions around it. We have a set term for the accelerator. In our accelerator, if you go through it, or if you get accepted, and want to go through it, we'll invest 100K for 6% of the business, and that values the company at 1.67 million valuation, for example. And so that's what they're valued at when we invest at them, and we own 6% at the accelerator stage. Then when they're raising their seed round, the goal of the accelerator is is the company able to successfully raise a round and grow. And so we typically don't lead investments. We'll co-lead investments, and all that means is like we don't write the biggest check and we don't set the terms of the seed round, right? We'll come in and participate in the seed round. So if it's like a $2 million seed round, we have the ability to come up to 50% of the round, essentially, but we're not going to be the lead investor, so we don't set the terms of that seed round.
It's up for the investors to decide what are the terms of the contract.
Exactly.
Is that what you say?
Yeah. Exactly. Yeah. And it really depends on, the business. If it's like a high growth business, they might get a higher valuation. So let's say they're doing, 50K in monthly recurring revenue and they're growing 10% month over month. They might get a higher valuation, $10, $12 million. We've seen that before. If they've got a previous track record, meaning, they sold, 2 companies before for $100 million, they might get a, $20 million valuation coming out of the seed. So there's different aspects to it. But we typically don't set the terms on the seed round.
So can we say that the minimum is 100K and the maximum is 6% of the value of the company? Is that how you see it?
So it's the minimum investment we make is typically 100K going through the accelerator, and then we'll own 6% at that point, and then we have this thing called pro rata, which allows us to we'll continue investing into the company in future rounds to maintain our 6%, or even invest more into the company to own more percent. But in most cases, we want to keep our pro rata, right? So we'll invest 6% throughout the lifetime of the company. And so that's how we look at it on the accelerator side. But on the syndicate side, just because we're able to write bigger check sizes through the syndicate, we can typically double down on the accelerator investments to own a bigger piece of the company. Yeah, exactly. So ideally we want to get to like a 10 to 12% ownership in the companies over time.
Great. So I think we had a great overview of the venture capital companies and how all of this works. So I have left with 2 questions. The first one is from your own perspective, in order to build a successful startup or company, what is your advice, or how do you see? What is your advice for the new startups?
Yeah, that's a good question. So I think number one is put out a product. So build a product around a solution or a pain point that exists, right? A lot of problems can be solved with a spreadsheet, like a Google spreadsheet or Excel spreadsheet, and productizing that spreadsheet, for example, to make someone's life easier is like a good start. And so I'd say number one is build for a market, or build a solution for a problem that already exists, right? That's like a good way to start. And then also, getting customers. So try to figure out ways where you can get customers. The good thing is, if you're solving a problem that people have, you'll just naturally get customers or users. Then you got to figure out if they'll pay for it, and then so on, and grow it, kind of thing. But that's like number one. It's just like building product. Another thing is just like, are you able to attract a good team? That's another thing. A lot of times it could just be like friends working on projects, but the friends are, one's like a sales type person, one's like a very technical focused person, and that tends to be maybe a good dynamic when starting up. And then like being lean. So a lot of about startups is running efficiently and you have limited resources, so you need to do and test a lot with limited resources. And so if you're able to do that, you'll be successful in one way or another because you'll get enough information. Um, you'll get these data points that like big companies won't get because you're a two-person team and you're able to, let's say, deploy code and get feedback from your customers that same day, that same hour. Whereas that's just not possible with big companies, right?
Makes sense. Makes sense. So I have one last question for you before we end this. We've crossed the 30 minutes
Yeah.
that I promised. So is the Silicon Valley a thing, or even what is Silicon Valley right now? Or do you need to be in Silicon Valley to come up with something that is cool, that is international?
Yeah,
From your own
yeah,
perspective.
that's a very good question. So from my perspective, and many people have different ideas on this as well. I think it's a, I think it's still a hub of talent and a hub of capital, and those are two very important things when you're trying to build a $1 billion, $100 billion company, right? Um, you need access to capital to grow, and you need access to people.
Yeah.
And the thing is now, obviously, with remote, is everyone's all over the place. Talent obviously has always been naturally everywhere, but people have naturally just came to Silicon Valley because of it being Silicon Valley, and that's why the companies became huge. But now I still would say there's still some element to huge companies being in Silicon Valley. Just because there is so much capital here, and things, if they do return, which hopefully they will, a lot of talent is still here, and that's going to be huge with building huge companies. I will say that there are exceptions to that, like Zapier as an example, built $1 billion company being remote. They just took their first financing like last year or something, or they did it like a seed round, and then they did a huge round last year with Sequoia, and so they're a fully remote company, but a huge brand now. So it's possible. I wouldn't say it's not possible. I would say it might make it a bit easier if you're here, but you can do it. You can probably end up doing it, anywhere,
No.
as long as, yeah.
There is one question that I forgot to ask you. What is the success rate of the startups?
Yeah. So naturally, like 80, 90% of them will fail. And that's kind of the business that venture capital is in, right? So it's taking these risky bets, and you hope that 10% of them end up being successful and end up being huge returns. So, out of 10 companies you invest.
So basically, you're banking on the 10% so that they can make up for the rest.
Exactly. Yeah. So in our case, we're investing in a lot of companies. So naturally, a lot of companies are going to fail. But the ones that succeed are, if we're doing our jobs correctly, the ones that succeed will be a huge outcome. Will be that that 1,000x return, and will return all the losses. So that one company pays for all the other losses. Is kind of how it works.
Great. I think that's it for me. Do you have anything else you want to add?
Amazing. I mean, if you're working on a project, feel free to email me.
Yeah,
My email is
sure.
fresh at launch.co, and